Hi, welcome back to another edition of Lippers Fund Flows Insight. My name is Tom Rizzi, and I'll be reporting flows for the week ended Wednesday, January 20th, 2016. I don't think anybody would be surprised to tell you that we saw some pretty big outflows. Nothing to write home about, no records or anything like that, but pretty big outflows for the week on continued concern about the slowing growth in the global economy, primarily due to China and some of the bad news that's come out of the Chinese market, and then also because of the big slides we've seen in oil. The price of oil actually dipped below $27 a barrel during this week, and it certainly was an impact on investor psyche. Actually, we've seen the Dow and S&P 500 slide for the week, down 2.4 and 1.6% respectively. And then if we take a look at the kind of year-to-date numbers, we get the bigger declines and where people are a little bit concerned, it's freaking them out. 9.3% decline, 8.9% decline respectively for both of those indices. And of course, if we take a look at the from the high in July, we're definitely into correction territory, maybe in the 11% area, in the 10, 11% area. And so a lot of people are very concerned. I think that there was enough positive news in the U.S. economy to keep actually, if not a rally going, at least keep some positive plus side returns on the equity market. So I do believe this is just a breather, and it's just a time period where you can call it a pullback and a correction. I think that's basically where we are, even though the Shanghai has had some huge losses. That is something that was kind of bid up on some speculation, and even some of the recent higher returns were bid up by insurers in China that were looking to kind of, if you will, pad the coffers at the end of the year. But that said, again, I think the United States is in good territory. Let's see how this impacted, however, the flows on the macro group. So equity funds lost about $2.6 billion during the week. Taxable bond funds saw about $2.6 billion, also flat out of their coffers. The only shining star in the sky right now is municipal bond funds. Last several weeks, we've seen about, in this case, $400 million net new money come to their coffers. Has been a little bit more in prior weeks. We'll see that later on. And of course, money market funds lost about $7.5 billion. Now, these aren't big numbers at all, and so I think the panic is stopping. But certainly, we want to get the detail of why this is going on and what groups are actually getting pounded the worst. Let's take a look at equity funds. Equity funds basically saw about $2.6 billion in outflows through their third consecutive week that they've seen outflows, and they suffered about a 2.28% negative return. The fourth consecutive week they've seen it, and about half about the volatility that we saw from the prior week. But again, a 2.5% return or close to 2.5% return in 1 week is fairly significant. I can see why investors are fairly freaked out on this issue. If we break this down into kind of what's been happening in the markets, domestic equity funds saw about $3.1 billion in outflows, and it's the 11th consecutive week that they've actually seen outflows. And ironically, non-domestic equity funds have seen about $500 million in net inflows. Now, it's a head scratcher because, again, people are concerned about China. People are still concerned about what's happening, over in the Middle East. And, of course, they're concerned about kind of the weakness that we've seen in the German and also European Union. And so it's just overall kind of a head scratcher, but investors are putting money to work, as they have been for so many weeks, in non-domestic equity funds. If we take a look at the breakout, though, large cap funds lost about $1.8 billion on the equity side. So people are kind of running still from the large cap funds. But ironically, they're looking for a yield still. So they put money to work in equity income funds. I don't even know if that's irony at all. I think it's, they're looking for places that probably got beaten up over here in the last several weeks and also have a higher yield. Of course, that happens when markets get crushed a little bit. Yield looks a lot better. On the international side, though, on the non-domestic side, basically we saw international equities taking about $800 million. And again, here's the irony. Emerging market funds took in $200 million in net new money during the week, and of course that's a little bit of a head scratcher considering they've had some of the biggest negative performances during that weekly period as well. Well, let's take a look at what's happened in the equity ETF arena, because that has actually kind of continued on to go hand in hand with what's happening in the mutual fund arena as well. So for the third consecutive week, we've seen outflows about $2.6 billion from this group. At the top of the list, though, we saw people going after safety, and I think that's the name of the game here: safety, income, large cap, familiar names. So S&P 500 took in $6.72 billion. And that certainly was a contrarian move compared to what they've done to other ones. They got rid of the kind of high risk areas. So we see the iShares Russell 2000 losing about $1.8 billion, and the MSCI, the iShares MSCI Emerging Markets ETF, losing a little bit under $1 billion, so about $910 million came out of their coffers. And so that's one of the things that we've been keeping an eye on is what investors are doing. Are they playing the risk averse card, which they are? And this actually went through to fixed income funds as well. So if we take a look at our next group of fixed income funds, we'll see kind of the same theme happen. Basically fixed income funds, we saw large amount of money leave the coffers, about $2.6 billion left their coffers. The 11th consecutive week they've suffered downside performance. Downside return, and actually the fourth consecutive week they suffered downside performance, and they lost about 0.95%. That's actually a big amount. If you're talking about weekly returns, to lose, that much money, to lose almost 1% in just 1 week, it's got people scared. Well, what we saw and the response by investors were putting money back to work in government focused areas, and the largest amount went to government mortgage funds, which have had kind of a heyday here recently, taking about $500 million, the 23rd week in 24 that they've actually seen net inflows come into their coffers. And again, this is a little bit of a difference because we saw treasuries actually taking some money. So while investors are concerned about the Fed raising rates, they're more concerned about the volatility out there, and so they're ducking for cover. And at the bottom, as we would expect, corporate high yield funds basically have lost money as well. About $1.3 billion. But if I go down deeper, corporate investment grade lost money, and then corporate flexible income portfolios lost money as well. And so that was something that investors, again, were following true to, is taking some risk off the table, buying those either that have been beaten up really bad or have, if you will, treasury or safety focus to it. And that certainly was held true if we take a look at the ETF universe. Usually there's a little dichotomy there, but in this case it wasn't. The ETFs actually saw positive inflows. That was the only difference. We had negative outflows for the open-end universe, but positive flows for taxable bond funds, about $2.1 billion that came into the ETF coffers, and second consecutive week that they've seen net inflows. And at the top of the group, as I told you, safety first. iShares 7 to 10 Treasury bond took in about $1 billion. iShares 20 plus Treasury bond took in about $600 million. And then we keep going down. It's still shy SHY. That saw a little bit of money, but at the very bottom, as we saw on the open end side, we saw that high yield and those type were actually set aside, and so the worst outflows for the ETFs was witnessed by the iShares iBoxx High Yield Corporate Bond Fund, and it is down about $573 million as far as outflows go, and that certainly was a story that we've been talking about for a while, is the safety play and why investors are actually making the run and going back to treasuries. Well, let's take a look now at, if we take a look at what happened to kind of one shiny bright area in the clouds that we've seen here recently, and that was the move into muni bond funds. Investors have continued this run for quite some time. Many bond funds have seen this week money come in for $422 million. It's the 16th consecutive week that they've seen positive flows, and it's the 5th consecutive week they've seen plus side performance. This time just the tune of 0.14%. But again, while we're seeing all this red all over the place, this was certainly something that investors have cheered about. Interesting enough, if you take a look at it, national munis took in 373, and so single state munis have been they've been kind of the pariah of late. They haven't been taking in money like the national munis. I think there is some risk associated with the single states. People are, certainly wanting to have the two benefits, so not only stronger return, stronger after performance or after tax return as well, but certainly they're kind of concerned about some of the kind of riskier areas that we've seen in Illinois in a couple areas. So maybe that's driven them to be more national muni focused than single state muni focused. That certainly has been the trend that we've been seeing. Well, let's take a look at what happened in the the money market fund arena. Money market funds saw outflows about $7.5 billion. Second week in 3 that they've actually seen outflows, and how this kind of panned out is taxable taxable money market funds saw about $7.6 billion in outflows. But how that really equated was there was about $10.5 billion in outflows from institutional money market funds, and then we saw about $2.9 billion in net new money come into the retail side. So obviously retailers are still putting money, earmarking the money, and some of this money from the, if you will, kind of corporate ends, institutional ends, are probably they're finding other places to go into, actually maybe moving money out to pay off 401ks, the year-end type of numbers that are out there, and so those are being distributed. So that's not too unusual for us to see that type of thing. Also, tax exempt money market funds saw about $1 billion of net new money come into their coffers. And that's, again, something that we've been seeing a trend of. Again, people are, year end, they're worried about taxes, but also they see some positive notes in the muni bond fund arena. Well, that brings us to our end, and basically we have the earnings season coming up, and that's not coming up. We're actually in the bloom of that right now. We're kind of at the beginning stages of it. I think that's going to be an important thing to watch. If we see some positive notes out there as the economy keeps tooling along, and if we can see some positive numbers, for instance, home sales, new home sales were down, but existing home sales were up a phenomenal number. So we've seen some, a little bit shake up in the economy, but again, it's the type of thing we see that it's going to continue on and keep tooling along. At least that's my opinion. Well, none of us are going to really know until we see it next week. So if you have, need to do a deeper dive, we'd encourage you to go to www.lipperusfundflows.com. If not, you can join us next week when one of our analysts will talk about the trends in flows in the mutual fund and ETF arena. Until next time, my name is Tom Rosine, wishing you the best in your wealth planning and creation.